Have you ever thought about growing your money but felt overwhelmed by the complexities of the stock market? You're not alone. Navigating the world of investments can feel like learning a new language. But trust me, it's a language worth learning. It's about taking control of your financial future and making your money work for you. We're going to demystify a powerful investment tool, exchange-traded funds or ETFs. Imagine owning a tiny piece of hundreds of companies with a single purchase. That's the power of ETFs. They've revolutionized investing, making it accessible to everyone, not just Wall Street gurus. ETFs are traded on stock exchanges just like individual stocks, but they offer a level of diversification that's hard to beat. Instead of putting all your eggs in one basket by investing in a single company, you're spreading your risk across hundreds, sometimes even thousands of stocks. VOO in particular tracks the S&P 500, which comprises 500 of the largest publicly traded U.S. companies. By investing in VOO, you're essentially investing in a slice of the entire U.S. economy. Alright, let's break down this ETF thing. What exactly are we talking about? In the simplest terms, an ETF, or exchange-traded fund, is like a basket of stocks. Imagine a big basket filled with apples, oranges, bananas. You get the idea. Each fruit represents a different company's stock. Now, instead of buying each fruit individually, you can buy the whole basket. That's what an ETF allows you to do with stocks. You buy a single share of an ETF and you're instantly invested in all the companies included in that ETF's portfolio. This basket approach offers instant diversification. Instead of betting on the success of a single company, you're spreading your risk across a whole bunch of them. Now that you know what an ETF represents, let's look under the hood and see how these things actually work. Each ETF is designed to track a specific index, sector, or investment strategy. For example, some ETFs track the S&P 500, some focus on technology companies, while others might concentrate on emerging markets. When you buy an ETF share, you're essentially buying a tiny ownership in all the assets held within that ETF. These assets are managed by professional fund managers who ensure the ETF stays true to its investment objective. The beauty of ETFs lies in their simplicity and transparency. Here's another great thing about ETFs. They trade on stock exchanges just like individual company stocks. This means you can buy and sell them throughout the trading day, just like you would with any other stock in your brokerage account. This ease of trading makes ETFs incredibly liquid. You can easily enter or exit your position whenever you need to, without having to worry about finding a buyer or seller. So, whether you prefer to buy and hold for the long term or engage in more active trading strategies, ETFs offer the flexibility to match your investment style. Now let's talk about why ETFs have become so popular. What are the advantages that draw investors to these investment vehicles? Well, for starters, ETFs offer a compelling combination of diversification, cost-effectiveness, and ease of use. One of the biggest advantages of ETFs is their low cost. Because they are passively managed, meaning they track an index rather than relying on a team of stock pickers, ETFs typically have much lower expense ratios compared to actively managed mutual funds. This means you get to keep more of your investment returns. Another key advantage is flexibility. ETFs can be bought and sold throughout the trading day, just like individual stocks. This gives you more control over your investments and allows you to react quickly to market changes. Now, while ETFs offer a lot of advantages, it's important to be aware of their potential drawbacks as well. One potential downside of ETFs is that their performance is tied to the underlying index or sector they track. If the index or sector performs poorly, the ETF will likely follow suit. This means you don't have the potential for outsized returns that you might get with individual stock picking, though the reverse is also true. Another factor to consider is the expense ratio, which is the annual fee charged by the ETF provider. While ETF expense ratios are generally low, they can vary, so it's essential to compare costs before investing. Let's dive into one of the most significant advantages of ETFs diversification. Now, you might have heard this term thrown around a lot in the investment world, but what does it actually mean, and why is it so important? Imagine you put all your eggs in one basket, and you drop that basket. Disaster, right? That's essentially what happens when you invest all your money in a single stock or asset. If that one stock plummets, so does your entire investment. Diversification is like having multiple baskets for your eggs, each representing a different investment. This way, even if one basket falls, you don't lose everything. Another great thing about ETFs is that they're professionally managed. Now, I know what you might be thinking, professional management. Doesn't that mean high fees? Well, here's the good news. ETFs are typically passively managed, meaning they aim to track a specific market index or sector. They're not trying to beat the market, they're trying to mirror it, and that's where the cost effectiveness comes in. Passive management requires less research, analysis, and trading, which translates into lower fees for investors. So, with an ETF, you're getting the benefit of professional expertise without breaking the bank. Think of ETF managers as the pilots of a large airplane. Now let's talk about a specific ETF that's gained immense popularity among investors, the Vanguard S&P 500 ETF. What is it about VO that makes it such a compelling investment option? VO is designed to track the performance of the S&P 500 index, which is widely considered a benchmark for the US stock market. The S&P 500 represents roughly 80% of the total value of the US stock market, making it a broad and comprehensive representation of the American economy. When you invest in VOO, you're essentially buying a tiny piece of 500 of the largest and most influential companies in the United States. We're talking about companies like Apple, Microsoft, Amazon, and Google, just to name a few. So, if you're looking for a simple and effective way to gain exposure to the US stock market, VOO offers a compelling solution. It's like having a one-stop shop for investing in the backbone of the American economy. Let's delve deeper into what makes VOO tick. Now let's peek under the hood and see what makes VOO tick. As we mentioned, VOO aims to mirror the composition of the S&P 500 index, which means it holds stocks in roughly the same proportion as their weighting in the index. The S&P 500 is a market capitalization weighted index, which means companies with larger market values have a greater influence on the index's performance. So you'll find that VOO has a significant allocation to sectors like technology, healthcare, and consumer discretionary, which are home to many large-cap companies. Within VOO's portfolio, you'll find a diverse mix of companies representing various sectors of the economy. This diversification is key to VOO's appeal as it helps to mitigate risk by spreading your investment across a wide range of businesses. One of the main reasons investors are drawn to VOO is its track record of solid performance. Over the long term, the S&P 500 has consistently generated positive returns, and VOO, as its faithful tracker, has closely followed suit. By investing in VOO, you're essentially hitching your wagon to the performance of the US stock market, which has historically trended upwards over time. It's important to remember that investing in the stock market, even through a diversified ETF like VOO, involves risk. The market can be volatile in the short term, and there will inevitably be periods of decline. However, for long-term investors, VOO offers a potentially less risky way to participate in the stock market's growth potential. VOO's low expense ratio further enhances its appeal. With an expense ratio of just 0.03%, VOO is one of the most cost-effective ways to invest in the S&P 500. Let's talk about one of VOO's most attractive features, its built-in diversification. With just one share of VOO, you gain exposure to 500 different companies across a wide range of sectors. This level of diversification is incredibly valuable because it helps to mitigate risk. If one company in the portfolio experiences a downturn, its impact on your overall investment is cushioned by the performance of the other 499 companies. VOO simplifies the process, providing instant diversification with a single purchase. This is particularly beneficial for investors who are just starting out or those who prefer a more hands-off approach to investing. All right, let's talk about the age-old investing dilemma, single stock versus ETF. It's a classic matchup, kind of like Coke versus Pepsi or cats versus dogs. Both have their pros and cons, and the best choice for you depends on your individual circumstances and risk tolerance. Investing in a single stock is like placing a bet on a single horse in a race. If that horse wins, you could potentially see significant gains. However, if it loses, you could lose a significant chunk of your investment. ETFs, on the other hand, are like betting on the entire field of horses. Your chances of winning might be lower than if you picked the single winning horse, but your risk is also spread out. Let's face it, the stock market can be a roller coaster ride. One day you're up, the next day you're down. It's enough to make even the most seasoned investor a little queasy, and that's where ETFs can provide a smoother ride. ETFs, especially those tracking broad market indices like the S&P 500, are inherently designed to mitigate volatility. Because they hold a diverse basket of assets, they tend to be less affected by the ups and downs of individual stocks. This built-in diversification helps to smooth out the ride, making ETFs a potentially more comfortable option for investors with a lower risk tolerance. Of course, no investment is entirely immune to market fluctuations. Real-world scenarios. When VOO shines, why choose an ETF like VOO over a single stock? Imagine you're excited about electric vehicles. You could invest in one company. But what if it faces issues? Now invest in VOO. VOO holds shares in several companies. This diversification mitigates risks. Investing is a marathon, not a sprint. Let's say a sudden economic downturn hits, maybe triggered by unexpected global events or a shift in government policy. The stock market reacts swiftly and dramatically, sending shockwaves through various sectors. In such a scenario, individual stocks, even those of well-established companies, can experience wild swings in price. Uncertainty and fear drive investors to sell, pushing prices further down. This is where VOO, with its broad market exposure, can act as a shield for your portfolio. While individual companies might struggle, the overall market, represented by the S&P 500, tends to be more resilient. VOO's diversified holdings across various sectors help to absorb some of the shocks. Even if some sectors are hit harder than others, the overall impact on VOO is likely to be less severe than if you were heavily invested in a single company or sector. Section 2. The Tech Bubble Burst. A cautionary tale. Remember the dot-com bubble of the late 1990s and its subsequent burst in the early 2000s? It's a classic example of why diversification is crucial. During the dot-com boom, investors poured money into technology companies. Excitement drove prices to astronomical levels, creating a bubble. When the bubble burst, tech stocks plummeted, wiping out billions. Investors who bet heavily on single companies were left holding the bag. Those with diversified ETFs like VOO were less affected. Section 3. Long-term vision, VOO, and the power of compounding. Investing is not a get-rich-quick scheme, it's a marathon, not a sprint. It requires patience, discipline, and a long-term perspective. And that's where VOO truly shines. By investing in VOO, you're essentially aligning yourself with the long-term growth potential of the US stock market. Over time, the stock market has historically trended upwards, despite short-term fluctuations and economic cycles. VOO allows you to ride this wave of growth while benefiting from the power of compounding. Compounding is like earning interest on your interest, and it can have a snowball effect on your investments over the long term. The earlier you start investing in VOO, the more time your money has to compound and potentially grow. Even small, consistent contributions can add up significantly over time, thanks to the magic of compounding. Embrace the power of ETFs. ETFs are a game changer in investing. They offer diversification, cost-effectiveness, and professional management. VOO tracks the S&P 500, making it appealing. Investing in VOO gives access to America's top companies. It's like owning a slice of the US economy. ETFs like VOO deserve a place in your portfolio. They provide a solid foundation for building wealth. Investing is a marathon, not a sprint. Make smart decisions today for a brighter financial future. Join the journey. Like, subscribe, and let's grow together. Knowledge is power. The more you understand about investments, the better decisions you'll make. If you found this video helpful, give it a thumbs up and subscribe for more valuable content. Investing doesn't have to be intimidating. With the right knowledge, you can navigate finance confidently. Join us as we explore investing, uncover hidden gems, and share insights to make your money work harder.